everybody that is doing lending right now on institutional volumes, i.e., clips of 25 million plus, is typically taking title transfer and in reality trading around those assets. And I'm being generous with the way in which I'm phrasing it. Something will blow up at some point.
Hello, welcome to Brainstorm. I'm Jamie Knowles. I represent Membrane on the European sales side. I'm joined today by my co-host James Roth, Head of Partnerships, alongside our guests David Arnold from Altenberg Capital and Freddie Mann from Arch Lending, where we'll be discussing what we saw across crypto lending markets in 2024 and what we expect for 2025. Good to have you guys on the podcast. The agenda for today is what we've all seen in lending in 2024 and what themes and narratives we expect to see in 2025. Maybe it's best, David, if you want to start in terms of also taking a little bit of time to explain what Altenberg do, where they sit in the lending spectrum, and then we'll move around to Freddie, James, and we'll just start to build from there.
Thanks, Jamie. So Altenberg, what is it? It's essentially a series of Swiss entities which is designed to mimic what exists in the traditional asset world in terms of securities lending, but in crypto, and then also pivoting very heavily throughout the course of this year to sort of satiate the need in Lombard lending, i.e., just very, very straightforward over-collateralized lending, but against Bitcoin predominantly, but other assets as well. The basic premise is, we've got a vast amount of digital assets under custody at the various different banks and custodians in Switzerland and in Liechtenstein. We're JV'd with a number of these banks in order to facilitate lending of and lending against digital assets. I think that the collision course between TradFi and the digital asset world is now in full effect. I think all of us can probably agree to that, given what's been happening over the course of the last 3 to 6 months. But the demand in terms of dollar and dollar equivalent borrowing against the large amounts of these assets that are largely dormant is manifest, and I think that's just what we're trying to meet and ultimately supply to other parts of the ecosystem in terms of infrastructure. But yeah, that's the basic premise of what we're doing.
Thank you. Yeah, exactly. I mean, in terms of when we think about what are the key growth areas for next year, lending, options, ETF growth, those are the three verticals that I really see in terms of seeing, big year-on-year growth. And Freddie, are you seeing similar themes over at your place?
Sure, yeah. Great to be here. So just for some context, Arch Lending is we do collateralized lending against Bitcoin, Ethereum, and Solana. We typically service a US market, so that's high net worths and businesses across the US. So the types of flows that we see is probably a little bit different to David. And I would definitely echo. I'm actually very glad I've been able to turn off my do not disturb on my phone. The Americans were waking up and prices at like 107K or whatever. So my phone's going to start ringing pretty soon. So yeah, it's been a very busy end to the year, and I think going forward into next year, it's just going to get busier. From our personal, I guess, from our business perspective, we'll be looking to enable more assets. So most of the flow we've been seeing so far is in Bitcoin, but you're definitely seeing that demand translate over to other assets as well. And yeah, as you said, options market, other verticals are definitely going to start playing a role going forward into 2025 as well. Total market cap of crypto must be over 3 trillion now, or around about there. Access to finance isn't scaling with, market cap is going up faster than more capital is coming on board, right? So you have
Yep.
a relatively currently, I think, inelastic like supply for finance. That's changing, like that's increasing, but it's not increasing as fast as Bitcoin's going up, right? So Bitcoin's adding market cap faster than people can find more capital to borrow. So rates ticking up. I think a big theme of 2025 is going to be more people getting into the space to provide financing. That's going to be different in Europe as it is to the US, and it's going to be different across different markets, different verticals.
And sort of, David, is that what you sort of been seeing similar as well on your side with the Lombard lending as well,
Well, I think absolutely. I mean, if you think about the context here based out of Switzerland, digital assets are a regulated asset class here. The securities, code, if you will, from a compliance, from a custody standpoint, from a trading standpoint, the Swiss regulator, FINMA, and indeed the FMA in Liechtenstein do not look at digital assets as essentially any different. Their bankruptcy remote, client segregation is key in this jurisdiction. So from a local perspective, collateralized lending against digital assets is one and the same with traditional securities-based collateralized lending. What we're now seeing is TradFi institutions, whether they be large commercial banks, certainly some credit funds, private credit funds, underneath some of the big asset managers. So think about what BlackRock and Franklin Templeton are doing on tokenized money market as collateral for lending. We're very close to that out of Switzerland, especially with Benji. But the key point is that traditional sources of credit are now coming in. We have, starting on the third week of January, we have 3 distinct credit lines, which are about $1.5 to $1.75 billion of notional that is willing to lend at 50 to 60% LTV. We're doing it as a fund structure. But bottom line is it's regulation and overall governance, which this jurisdiction affords one. 2, the marked impact of fresh capital coming in, I think directly talking to what Freddie was referring to, will bring down borrowing costs to the end consumer, whether they be institutional or retail, and perhaps bring the prevailing rate, was it mid-teens plus in the US, lending to the miners, some of the guys that we face as counterparties. On this side of the pond, we are looking at high single digit, albeit with much, much lower LTVs. We're trying to cut a middle point between that, which is 50 to 60% LTV, high single digit, maybe touching the low end of double digit on short-term lending. And I think this is the key bit from my perspective. Everybody that is doing lending right now on institutional volumes, i.e., clips of 25 million plus, is typically taking title transfer and in reality trading around those assets. And I'm being generous with the way in which I'm phrasing it. Something will blow up at some point. People think that they are borrowing dollars against their collateral and it is locked. And in some instances, it's being put forward as being locked at a custodian, but in reality is being used as trading collateral. And that is inherently dangerous. We've seen this before in the various sort of, incarnations of lending over the last 5 years in crypto. The interesting bit from what we're seeing, and I'd love to know everybody else's perspective, that the number of credit lines that are coming in that we're facing against any custodian on the other side in a regulated manner to provide proper scalable collateralized lending rather, is surprising. It certainly surprised myself and my 2 partners here in Zurich. The more competition, the better. But of course, underpinning that, the biggest problem for us has been having a margin engine and a vehicle in order to properly book these trades and manage the event risk of liquidation. And of course, I think maybe James and Jamie, you guys know more about that than anybody else on this call. I mean, obviously, Freddie, you guys have a very well thought through platform, but underpinning what we're doing is essentially outsourced margining and against essentially portfolio management behind it.
Thanks, David. Yeah. So, just a friendly reminder, Membrane is simply technology. We are not a lender ourselves, but we're technology for the lending space, whether it be institutions or more retail facing applications. I That's exactly what we're seeing too, David, is that it feels as though the market is going to, and I can't believe I'm saying this, but it's going to repeat itself again. And the same things that happened in 2008, that happened in 2021, 22 timeframe are happening again. I do think it's somewhat stratified in that I do think you have conservative entities, particularly retail aggregators, that now have learned their lesson from some folks that have, exhibited some poor behavior in the past, and they're kind of stewards of capital and handling that capital in a very conservative fashion. So they're maybe taking retail deposits and lending them to very trustworthy institutions. But we hear from our clients that there's a group of some are family offices that have a significant amount of flexibility. Some are high net worth that, the same amount of scrutiny borrowers are not put under. There's a lot of highly speculative direct lending being done in very large sizes that don't require a significant amount of due diligence. I don't think this is widespread, but this is certainly out there in certain pockets. And so it becomes very difficult for some of the wholesale lenders in our space who want to lend institutionally. They're now getting crowded out of doing, for example, under collateralized or uncollateralized stablecoin lending or fiat lending, because it's just done at rates that aren't really competitive. However, what I would say, earlier to Freddie's point, I agree. Capital is not scaling with the price, and obviously highly correlated to the price is the both the demand for lending, but also now I do think what we're starting to see, and this is true in terms of who we service here at Membrane, is that the big player we're looking to in 2025 are the custodians that are going to start to come in, who hold a significant amount of Bitcoin and other digital assets, and them coming in and offering lending more in a walled garden where they enable trading and they enable other capital markets behaviors that whether it's high net worth or institutions want to take on, but they have the infrastructure, leveraging Membrane in many instances to be able to do that in a very safe and conservative way that's constructive for the industry and helps it grow.
And one of the things also, James, I think in terms of feedback that's helped to bring these new traditional sources of balance sheet who are willing to lend is the understanding now of Bitcoin as pristine collateral. And I definitely think, that is a buzzword that's been used over 2024, but I think it's become progressively more ingrained within TradFi and more understood. And you're starting to see traditional players really starting to build around that. For instance, Cantor Fitzgerald now starting to set up Bitcoin financing, and there'll be a first mover advantage to sort of set up the way for others to come in, especially what we hope will be proactive custody rules, accounting rules, etc., and ways that banks treat digital assets on balance sheet as well. So like you said, the infrastructure build out, which is obviously where Membrane come in, combined with like the improving narrative around Bitcoin as pristine collateral. And I think, the tightening of the bid and the ask in terms of the lending rates themselves, I think is going to make for a very, very constructive 2025.
Yeah, I'll also say, just not to toot everyone's horn on this call, but I would say that there's been a significant upgrade in human capital that's come into the space as well. So in addition to the technology and additional kind of understanding the market microstructure, is highly credible professionals that have done this in the past. And I do think that on the first go round, when you had the Celsiuses of the worlds and others, that was more, hey, we kind of just lucked into the space. We need to set up a lending business because we know we ought to, the Voyagers of the world. And now we're starting to see seasoned professionals who come out of lending from TradFi who have kind of, hopefully learn from the past. I think that really does help because even if you're running a business on Google spreadsheets, it's the know-how and it's the understanding, and obviously the technology does help. But I think that's a huge difference in the leveling up of talent that's come into the space since the last time we've had some hiccups. Can't change everyone's behavior, David. You know what I mean? But because folks will be kind of push everything to the extreme. But yes, I do think having most now folks that are in the market that are scaling lending functions. They have significant experience and really do know what they're doing.
Just to play off a couple of things that you said, Jamie, on the pristine collateral side. So we see a lot of flow from kind of high net worths in the US. And as David said earlier, that rate, it's mid-teens, around 15%. They come and they say it's a bit high, right? And I think one of the reasons is because traditional finance doesn't necessarily understand the asset properly as pristine collateral. So the people who come to us looking to borrow are like hardcore Bitcoiners. They've been Bitcoin since 2012, 2013, 2014. They understand the asset very well, and they're like, this should be way lower. Why is it so high? And you kind of have to go and explain, look, the people we raise capital from don't necessarily have the same view. They haven't taken the time to understand the asset as you have. So what I try and kind of explain to them is, you will get lower rates in the future, but the price is going to be much higher. Like, there's like an inverse correlation between those two things, right? So once they kind of understand that, they're like, okay, well, it kind of makes sense for me to still borrow at the higher rate, because as that rate's down, price is going to rate up as, TradFi just comes to grips with what Bitcoin is as an asset class, right?
Yeah, and I think what you're doing is interesting, Freddie, as well, because you guys at Arch are opening the doors to new types of collateral, i.e., a lot of the market is predominantly built around BTC as the collateral engine. But, you guys are opening the way to using ETH, using Solana, potentially using other altcoins, whether it's individually or in blended form, to potentially, have an ability to draw down capital against those. Obviously, there are respective haircuts depending on what the blend and the asset itself is. But again, it goes towards the fact of individuals and funds now being able to more productively use the assets that they have to withdraw capital or use to take capital against in what we feel is a more constructive and safer framework as well.
Majority of the flows is still absolutely Bitcoin, but a lot of these assets have great liquidity, right? So Ethereum, Solana have great liquidity, which is like one vector you can think about managing your risk from our perspective. And as I said, total market cap is like $3 trillion, I think. 60% or so of that's Bitcoin. There's still 40% of like other stuff that you could finance against. And I think, going forward in 2025, you're going to see like a lot of colorful solutions to financing against, top 5 assets, top 10, eventually top 50, top 100. And I think, not something we're looking to get into too soon, but I think if you fast forward a few years, you're going to see a lot of esoteric financing solutions where people could be lending against block tokens or, vesting tokens. I think there's still loads of space to do funky solutions around that for like venture firms, for instance.
I think some of those solutions are really going to come on chain as well. I think, you're already starting to see a lot of activity shifting away from like OTC to on chain. And that's been shown in the data and the metrics, and especially a lot of these institutional pools where there's like heavy due diligence done around whom you're interacting with in terms of either who you're lending to or whom you're borrowing from. And I think those are going to see big growth in 25. And I really do think if you're an OTC lender, your two biggest competitors are actually not the other OTC lenders themselves, but they're actually the exchanges who are improving the ability to borrow large amounts of coins at more competitive rates and on-chain as well.
Counterparty credit risk is probably the most important thing. I spent 2 years at Hidden Road. The counterparty credit risk that the market faced going through FTX was perhaps should have been expected. I think perhaps maybe it was underappreciated. But going forwards into next year, we're talking about over collateralized lending, but I think, James, as you alluded to earlier, the natural bedfellow to this is yield enhancement via options overwriting. The same kind of principles in terms of counterparty credit risk apply there. So, what we've been doing is, not just against BTC, but also ADA, staked ETH. We lend against all of these assets because it is a bona fide collateral. certainly under the eyes of the FMA and FINMA. The interesting bit is the willingness to do it, to lend against these assets whilst they are custodied at bank or custodial institutions that are regulated under bankruptcy remote FINMA and FMA guidelines in Switzerland, Liechtenstein, is the first point. The second bit is the same principles are applied if you're doing overwriting and you want to generate a yield against these large dormant assets or pristine assets, I think, as you've elegantly termed it.
Just to like rewind to, I'd say, last cycle, 2021. Yeah. So there, I think like one of the key issues was you didn't have a lot of outside capital looking in at all. It was basically, there were a few people who were lending off balance sheet, right? And so the other lenders spinning up around that were like necessarily rehypothecating because there were a few sources of the same capital, right? Yeah. So that cycle was just, everyone was rehypothecating because only a few people had any money in the first place. Now what you're seeing is outside pools of capital that people can tap into. So for instance, we raised a CLO. David, you'll be familiar with that structure, of course.
Okay.
That's provided by Galaxy Digital, and that allows us to tap into this credit line, essentially. So we keep all the assets at Anchorage Digital. Again, you'll be familiar with that, institutional grade custody in the US, federally chartered bank, OCC regulated. And we keep assets there and draw on this credit line. So that's effectively like non-crypto native capital that's now coming into the space. And that's structured such that other large institutions, banks, you've mentioned some of the names already, they would be able to potentially take senior of that facility and come into it. And that goes a way to explain how we can kind of scale into the market now as well. So previously, I think that the issues of rehypothecation and scalability were intertwined, and we're trying to kind of, disentangle those concepts.
Right.
Yeah, exactly. And we are seeing certainly from the membrane side, new agents, so various agency lending desks starting to spring up, whether it's in Europe, US, or Asia. Like I said, within these various regions, they are finding large institutional pockets of capital that within a regulated or what they feel is a compliant and safe framework are willing to lend fiat against Bitcoin as collateral. And I do think, again, that's going to be a big growth area for 2025. One of the other things that we're starting to sort of see small pockets of, and I think it's going to be a big focus area for next year and 2026 as well, is in terms of like how the custodians and the ETF providers engage with lending, because they're unfortunately facing structural headwinds whereby they're seeing ongoing fee compression in very competitive markets. And they're in the unique situation where they're long coin. And, in order to offset the reduction in fees, there is an opportunity for them to scale out lending operations, and we're starting to see, those initial inquiries around how they would look to build out those types of businesses. Is that something that you guys agree with? Have you had any feedback to sort of corroborate?
Absolutely. I mean, maybe I'll just touch on it very briefly. The way in which we've envisaged we're essentially done it as an AIFM fund structure out of Liechtenstein, is for us to be able to face any of the qualified or regulated custodians in the space. I think that's incredibly important. There has to be interoperability. Before this sector can scale, you've got to maybe not see a harmonization entirely in terms of regulatory governance. The Trump administration has obviously signaled that they will be taking a very much more proactive view on this. Our hope is, certainly from the Altenberg vantage point, is that the Swiss model of essentially expanding the regulatory framework around traditional assets, i.e. securities, trading and custody governance, will essentially just incorporating digital assets into the TradFi space. That will be applied in Singapore, in other jurisdictions, perhaps in terms of harmonization. That will allow for a consistent viewpoint on essentially credit capital to face into these markets from a lending perspective, a margining perspective. We need more portfolio margining. We need more underlying over-collateralized lending.
And Freddie, David, are you guys seeing new use cases for what people are doing with the demand, or is the demand strictly, hey, I'd like to borrow so I can put on a basis trade, or is it mainly trading related, or what else are you guys seeing from what folks want to do with the actual funds?
That's a great question. I mean, I think we'll have two different answers here. I'd say like we see five different types of flows. So first is like hedge funds, obviously doing hedge fund stuff. David's going to know, he'll know more about that than we do. But hedge funds, venture funds, institutional lenders, I think that's one kind of section. Generally, they're doing some sort of leverage or basis trading, as you said. The few others we see just from the high net worth business side is personal expenses. So, we certainly have clients who are like, financing their Ferrari payment or something like that. Yeah.
Oh, that was David. Oh, right. Yeah, I remember that.
And then we have a few others as well. So we service some small businesses. So I think what's been really interesting over the last year or so is increasing small businesses from middle of nowhere in like crazy industries. So I don't know, toys, miners, obviously, but toy companies, farmers, irrigation companies. We see these guys across the US. They're looking to Bitcoin to hold on their balance sheets as a store of value. And they will borrow against that to meet their daily cash needs in terms of OPEX or CAPEX. That's been a really, really big use case for us so far. And just very quickly, the other one is debt consolidation as well. So, people have, high interest personal loans. They come to finance against their Bitcoin as it's a cheap source of capital for them.
We have a relationship with a lot of the large miners who are trying to bring down elements of their cost of borrowing. We've obviously seen some large convertible bonds being issued by the large public listed miners in the US. I think for the smaller guys and maybe the unlisted names, they are looking to bring down their cost of capital and therein the cost of debt. A lot of hedge funds, a lot of family offices. The interesting emergent piece of the lending market is actually also match principal. So, as I referenced earlier, we have a JV partnership which is SEC regulated here in Switzerland. We can bring in US capital in Bitcoin form, hold it under fiduciary control in Switzerland, and we can lend a Bitcoin against a Bitcoin from Liechtenstein. So the interesting bit there is, of course, it allows for direct investment or direct use of Bitcoin on various venues, for example, Deribit, direct investment into hedge funds in kind form, i.e. Bitcoin, Ethereum, or other assets. I guess it's the liberation of this capital, which is important. A lot of real estate investment, perhaps people just seeing other means of generating yield where, there's a client with a large amount of ETH that is actually now financing a big real estate portfolio for personal usage. Huge, eye-watering sums, but this is what's being done, and I think it's diversification away from an asset while still holding the asset. People don't want to sell down these holdings, and for good reason. We've seen Bitcoin go up 130, 140% this year. People know that there is sovereign wealth activity. The interesting bit is, we run a regulated or an SRO-approved Swiss escrow platform for block trading, which is obviously the adjacent piece to securities lending, to margining, and also then the adjacent piece is block trading. The bit that's interesting is what these large holders of coin are doing with the proceeds. They are lending against Bitcoin even more. They are facilitating large commodity trades. So if I think about the other piece, which is important, the new entrant, not just the hedge fund community, the alternative world and the TradFi waking up to digital assets being a great source of alpha, is the commodity traders. A vast proportion of global commodity flows, physical commodity flows, go through Zug here in Switzerland. The interesting bit is, if you look at how physical oil is priced, physical coal trades, it's not all in USDT. A lot of it's in Bitcoin. If you look at what the Venezuelans have done over the last 12 months, these trading entities, they hold a lot of digital assets as a result of that activity. They therefore want to sweat those assets. They want to borrow against them. They want to lend into it. They want to generate yield via options. And now they're actually setting up individual trading desks, which allow for that as well.
Freddie, one of the things that you said that I thought was particularly interesting was regards to, like you said, businesses or individuals using Bitcoin as collateral to take capital against to pay down business expenses, etc. Because one of the key themes for 2025 is going to be ongoing corporate adoption of Bitcoin. So obviously, MicroStrategy in the US, Metaplanet in Japan have been pushing ahead. You've had the miners coming on board. But we're now expecting to see more public listed companies globally, as well as private companies looking to add Bitcoin as a treasury reserve asset, i.e. taking part or all of their cash and putting it into Bitcoin. And over time, expecting easy solutions to come through that allow those small and medium businesses to be able to withdraw capital against Bitcoin. And the numbers individually might not be as large as the wholesale lending, but collectively, in terms of a segment, I think it's going to potentially drive a lot of lending as well in those sort of small, especially in those smaller risk clips, which I think in general also do tend to be more profitable for the lenders as well.
Yeah, no, 100%. I could give you the whole Michael Saylor speech here. But it's definitely something that we're seeing. And as I said, across the US, across all different types of businesses, people are independently just reaching the conclusion that the best thing that they can do for their business balance sheet is hold a portion or all of it in Bitcoin, because it's a reliable store of value. And these treasury services, such as borrowing against your Bitcoin, even just being able to, securely store it and access it through like a structure in the US, opening up an LLC and having securing it via multi-sig or securing it at a custodian. A lot of people didn't know how to do that. They've kind of figured that bit out now.
Yeah.
And now they're going to try and get financing against it and just seeing how they can use the asset efficiently to the benefit of their business.
Yeah.
Yeah, it's just interesting though. Like I think as you guys are discussing, and this is kind of an obvious observation, but effectively folks are using digital assets to finance operations or activities they want to take that don't live on chain. And so it's there's a significant amount of friction that exists between the traditional financial world and traditional players that want to be in the digital asset space, but don't feel comfortable leaving things in smart contracts, don't feel comfortable taking on-chain operations where there's unspecified KYC AML requirements, and all sorts of regulatory risks that they touch. And there's really like no interest in leveraging any of those funds to participate in DeFi. And so I continue to believe, even though we're all talking about 2025 as more lending coming in, the scalability of that is difficult in my mind, because they're all going to live in these different pockets, whether it's off-chain trading or in a walled garden, or it's just, and it's also somewhat of the wrong word's indictment, but it's definitely a wake-up call for the space, in that it just hasn't created enough offerings, or it hasn't demonstrated significant amount of utility with which people feel comfortable interacting to drive real flows, real capital flows on chain. And so the hope is, as we see it, and this is where Membrane is focused on, is how can you bring hybrid structures, or how can you get comfort to institutions who want to operate in a safe space? I know we've been saying this for years in the space, but now it feels like some technology has come together to potentially give people greater comfort. Is how do you get those participants on chain, and how do you kind of feed this back into the ecosystem and create greater growth for capital markets transactions that live and breathe on chain? Or it might be using the proceeds of a loan that's been taken to pay for bandwidth, or to pay for compute power, or whatever it may be, kind of in the deep in space. So, I don't necessarily have a question, but it was just, as we're talking about it, it sort of, it struck me as there's these two kind of divergent worlds for the institutions who can't really participate on chain in any meaningful way.
Yeah, I think there's two distinct. There's like theory and reality, and a lot of what you said. If you're maybe slightly older, on the older side, you're not super crypto native. You're used to dealing with banks and paperwork. it's really difficult to go to like on chain. There's no contract. There's no one you can call. You're doing this stuff from your laptop in a little browser extension. Like in reality, these people want to be able to call me on the phone, say, hey, look, can you walk me through this process? How do I do this? I want to make sure that I'm being, doing everything in a compliant fashion. I want to make sure that I'm not going to, misclick my Bitcoin and send it somewhere. If they're trying to wrap their Bitcoin and go on chain, it can just get really, really difficult. And I'm sure we've all heard horror stories. Even having like an MLA, they can show to their bank and say, hey, this is how I just got $1 million into my bank account. It didn't just appear from nowhere. That stuff goes a long way right now. And I think, okay, if you fast forward 10 years, maybe things look different then. And I think hybrid solutions exist. We might be able to tokenize our debt facility and put it on chain. That brings us into the capital markets on chain. But I think there's always going to be a space for a centralized company, not like a DAO, centralized company interfacing with its clients, its customers in a white glove capacity.
No, we totally agree. Definitely for the foreseeable future. I just think for the folks, the broader kind of space, celebrating everyone coming on chain. It's very kind of it's very isolated, or should say it's kind of in its own world in a very specific way in which they're coming on chain. It's not full scale adoption, and they can't. To your point, Freddie, they can't.
And I think that's part of what we've been trying to meet the demand for, trying to act as that interface. The tech solutions that you guys have built from a client-facing standpoint, or the ability to deal with the margining and the portfolio management that's underpinning it, is one thing. The regulatory governance around being able to face both sides is hard to do, certainly outside of the jurisdiction that we sit in, because it's ill-defined. And by May of next year, we will have a securities broker-dealer license, traditional securities broker-dealer license in Switzerland, with which we aim to essentially issue quasi-bonds backed by Bitcoin. That's the real interface between some of the TradFi institutions here and elsewhere, certainly under MiCA. We can passport to MiCA from Switzerland, the interface thereof. But the interesting bit is it also affords one the ability to, for example, lend on-chain or off-chain against, for example, hash rate. As soon as you securitize hash rate, you can then lend against it.
Right, I think we are coming up to time here, gents. All this has been super informative. Maybe, any final parting words from you guys, whether it's in terms of like how people can reach out to you, what you guys are planning in terms of like rollout for 2025, any closing remarks. Freddie, do you want to kick it off?
Sure, yeah. I'd say for anyone, ideally in the US, but preview for 2025 will be rolling out internationally shortly. Wants to explore financing against their digital assets as an individual, you can visit our website www.archlending.com. Process is very quick and easy. There's loads of material on there. You can also reach out directly on Twitter or across any of our socials. And then going into 2025, I think we'll be rolling out a bunch of new exciting products, expanding internationally, as I said, and expanding asset coverage, hopefully, too.
Great. David?
Well, I don't have any presence on socials, but if you do want to get hold of me, DLA@altenberg.capital can usually be found on email. But I guess if as a institutional counterparty, and by that I include family offices, if you want to generate a yield against your reserves of digital assets, or you want to borrow against it, don't think of us as a end lender. Think of us as a conduit to the provision for yield enhancement, for generation of yield, whether it be through lending the assets or borrowing against it. We aim to do that in a regulated manner and with mitigation of counterparty credit risk. And I think that is, acting in tandem with institutions such as Freddie's and Dean James's is exactly what is required to scale this sector. I'm not going to give a prediction on Bitcoin because, frankly, that's trite and useless. I learned that as an equity analyst. Giving a target price is about as helpful as a chocolate teapot. But the direction is upward facing. The volatility will be obviously manifestly large, but the trajectory is the important thing to look at, and it's upwards and it's bullish.
Yeah, perfect. Thank you, James. Any closing remarks from you?
Yeah. So membranelabs.com. You can reach out to me directly, james@membranelabs.com. Probably the best way via email. But in terms of 2025, we have a significant number of product enhancements on the way, inclusive of the ability to both access as well as observe a blend of all of the various lending markets that exist, or the principal components of lending markets, to be able to make better decisions about how one lends or how one borrows. That's the tip of the iceberg. We're also looking to push the envelope on new structures of lending that enable kind of the hybrid on-off chain behaviors that we're excited to kind of move forward.
Just to put it in perspective, in 2024, the amount of loan bookings that we've seen on the platform were nearly 6x what we saw in 2023. And that's in terms of driven by obviously more breadth in terms of the individual sizes of the loans and the types of clients as well. So expecting to see a further pickup in 2025. So really appreciate everyone coming onto the call today. Thank you very much.
Absolutely. Thank you for having me.
Cheers. Thank you, guys.
Thanks, Dan.